Hello everybody, this is Wendy from HMO Success, and thank you very much for joining me for our live interview this week, which is with a fantastic guy who I met a few years ago, who is a prolific property investor and who I personally have learned a lot from over the years that I've been following him and followed his journey and his progress. So the person that I'm going to be introducing today is Mike Frisby. Hello, Mike.
Hi, Wendy. How are you?
I'm very well, thank you. How are you?
Yes, good, thank you.
Great. So, Mike, thank you very much indeed for coming onto the podcast today and also onto the video, which we're going to be streaming to Facebook. I really wanted to get you onto the podcast because, you know, I've kind of been secretly following you, but a bit of a secret admirer for a few years, seeing what you've achieved in property and some of your amazing deals and amazing, if you like, ways that you have maximized your deals, the way that you've added value to property. I think it's quite extraordinary. So before we get into all of that, though, I'd love to just understand a little bit about you and your background. What first got you started in property?
What first got me started? I was always, I guess I've always been fascinated by property. I guess it all started because I was looking to make money, and it was like, how do I make money? And I kind of thought property does make money, but it took me years to find out how property makes money, because back in those days there wasn't really an internet and that kind of stuff. So it was actually quite difficult to find out. So I just sort of thought, well, but property's so expensive. How can you buy a second property? I had my own property, but it was like, how can you buy a second property? I didn't even know about buy-to-let mortgages. I didn't know you could get a mortgage on another property. So, you know, I've been on a massive learning curve since then. So it was really about, I think property is a good way to make money. And then I went to the Property Investor Show in Excel, and I managed to find some people who would help, you know, educate me a little bit. And in those days, it was kind of manual. I think I bought a manual or something and had to read it all. None of this online stuff, none of these videos that we can all watch today. So I had to pour through that. And then I started to fathom it out. I did do a little bit of mentoring and coaching. And literally, I just then, the light bulb went off, having procrastinated and sort of for probably 5 years from the initial idea of buying another property into, and eventually I did. So, yeah, and it was all about, I guess, increasing my you know, money. And I thought this was a good thing to do. I was always fascinated with, I guess, business, and, you know, initially it was also stocks and shares and just making money, really being a bit of entrepreneurial. I think I've always been entrepreneurial. So it was that streak that led me into property, really.
So what were you doing at the time?
So I was in the corporate world. I was in marketing and strategy. The first property I bought, I was working for Unilever. Unilever does all the loads of brands in the supermarkets. So things like Dove, Lynx, Persil, Hellmann's mayonnaise, Marmite, Knorr, Magnum ice creams. So just so many brands in supermarkets. And I was in the personal care side. And I did a lot of research on, you know, there was a bit of internet then, and I did spend some of my working day researching online. I discovered these the people who produce reports and stuff. So I was devouring, reading those and trying to understand. And also I was interested in Eastern European property as well, because that was like the phase of,
yeah, that was a big thing at some point, wasn't it?
Yeah, off-plan Eastern European, because the kind of off-plan had been happening in the UK, and they said the next big off-plan, big discounts, lots of growth was going to be in Eastern Europe. So I was also considering that. And
did you invest in Eastern Europe?
I did do one investment in Eastern Europe, in the Czech Republic,
Okay.
which went okay, and then I exited it pretty quickly. I did an off-plan, so yeah.
So were your first investments kind of vanilla buy-to-lets? Is that how you sort of got started?
The very first UK property was actually, it was a source deal, because it was like, I just knew I needed to get going, and I knew I needed to do something that was the best thing I'd kind of seen. So it had a good return. and there was a bit of a discount in it, and the way that the financing was structured meant I didn't need to put a lot of money in, and I just thought, well, that seems okay. So it was a source deal, and it was an HMO. It was actually a student HMO, 5 people, and I went ahead and bought it.
Wow, that's great. You see, that's really interesting, because my very first property was an HMO. This is before the word HMO had even come into parlance. It was, I think in those days we just called it a student multi-let. And like you, I was brand new, and yeah, student let. And
so early on, I bought a few student lets because they gave good income, but I always struggled to find student properties at good prices. However, if I look back now, I wish I'd bought more of them, not focused on the discount and recycling. They have been some of my best properties. So, you know, it's funny because, you know, I was very much focusing on discounts, adding value, recycling cash. That was my ethos to begin with. And that was what the education was saying at the time. They didn't really talk about cash flow. I had one eye on it, but didn't really have a strong enough eye on it. And then the credit crunch came, and that all changed. And that's how I then got into social housing and then professional HMOs sort of on a mass scale after that. But at the initial time, it was all about buying at a discount. And kind of one of the areas I was buying in was in Guildford in Surrey. And the properties went through the stamp duty threshold. So in those days, it was quite a big step change to go once you went through £250,000. So all of a sudden, I was near on 10 grand stamp duty, having been sort of more like, you know, 2 grand. So it was a big jump, and that kind of stopped me, because it was like, oh gosh, all of that to buy the same property today would be an enormous amount of money in stamp duty because of the 3%. And I don't blink much about stamp duty. I just see it as part of the process. So that's how it kind of started, and it kind of then went, I can't do much more, but I do wish I'd bought more in Guildford, and that I'd stuck in that patch. But I headed down south, further down the A3, and hit the south coast, and the yields were much better. And I thought, well, actually, you know, the rents aren't that dissimilar, but the prices are a lot less, and also there's going to be lots of deals. And in a way, it has done me good as well, because I then sourced a lot of deals down there, and then that's when I first went frantic. I kind of if I look back, I kind of work things out, then I go frantic for a while, and then I kind of like pause and mop up the mess a bit, and then and then learn something else, because again, being a creator, I'm like always looking for, I like to stretch myself, learn new things. So I've done a lot in property, but actually I have focused in on things, you know, not done other things at that same time. So yeah.
So that's really interesting, because I think that a lot of people are always weighing up this, the two, if you like, golden geese of property. One is capital growth, you know, how wonderful that can be, and also cash flow. And it sounds like in your early days, you were weighing these two up. And of course, capital growth is one of those things that we only see in hindsight. You can't predict where is going to have capital growth. As you say, if you'd invested more in Guildford, now those properties would be worth probably 6 times, maybe 8 times what you paid for them back then. But you weren't to know that. So for people who are maybe, they've got a few properties, or they're starting out, or they're starting to think about HMOs as an investing strategy, how have you managed to kind of navigate those two seesaw ends of capital growth and return?
I guess it's looking at need as well, isn't it? I think when you decide where is the emphasis on that seesaw, I always look at it as a seesaw. And, you know, some people are like, well, I've got a really good job, I don't want to leave it, so I've got a lot of income. If I earn more income out of my properties, I'm going to get taxed heavily on it. So I don't need much more money, so I want that as a pension pot. So that's all focused around capital. So I just look at where I am, where I was in the journey, where I was in terms of income, cash, and outgoings, and predicted outgoings, and versus, you know, and money in the future. You know, initially I was quite focused on capital, because that was the way of property in those days. I even heard of people buying, you know, lots of property up north and not even bothering to fill them, because it was like, well, they'll double in a few years. Why am I bothering with with all these pesky tenants? I think they came, yeah. So it was like, don't need to, because it will just increase, and who needs to. So there was some really, swing around capital. So initially I was quite focused on capital, a little bit focused on income. Then I realized with the credit crunch, I really needed to switch. And since then, I've been very focused on the income side, less focused on capital, purely because capital, as you say, you just don't know what's going to happen. And it can go up and down, and it can, so it's almost, that's the bonus at the end. That's the pension pot. That's the, for the longer term, and just make sure that you can cover everything through all of your income in the meantime. So
yeah,
but I have always sort of thought, where is a good area to invest? Is there likely to be some capital growth here? And tick some of those boxes. But it was always really about, what is the cash flow out of this property? Certainly over the last decade, it's all been, what is the cash flow? What is my return on investment of money that I'm leaving in the property? And is that good? And if that's good, that's fine, because eventually I'll get that investment back after the property goes up in value.
So Mike, what about some of the deals that you've done? I would really like to know from you, because you asked me this last week when you interviewed me for your podcast. You asked me what one of my best deals was and what one of my worst deals was. So I'm going to turn the tables and ask you exactly the same. And this time you've had no preparation. You were very kind in giving me the questions, but I'm just going to shoot these at you and see how you respond. So I'm sure you've thought about this though. What can you give us an example of, what's maybe your best deal? Let's start with the goodie and then we'll get into the baddie. What was the best deal you would consider you've done?
Oh, I can't remember all the figures. There's a couple in mind, actually. I think I've done some good deals over time. But there's a couple in mind. One was a block of flats, of eight flats, in West London, which I bought below value, refinanced, which basically meant I hardly put any money into the deal. And obviously today they've gone up a lot in value. And cash flow very well. So what was I'm trying to think what the price was. So it was the way that I structured it. I learned that was a freehold to leasehold. I bought the freeholds, created leasehold titles. I refinanced. I had a lot going for it. The seller was desperate to sell, and we kind of had a deadline. And I was literally, I just remember when we completed, it was like, whew, there was a lot of big relief. But it was
when you converted that into, so presumably you took the freehold, you then put leaseholds on all the flats. Did you then refinance per flat?
Yes.
Okay.
So in those days, it was very much you refinance per flat, and I refinanced it. So I got each flat valued individually, refinanced, pulled the money out. It was a good discount in the end. And also it's had good growth since then as well. So I'm just trying to think what I bought it for. I think it was valued at something like 1.25 million. And I buy it for about 950, something like that. Mm-hmm. I think, and it cash flowed from day one, and the cash flows just got better and better, partly because interest rates have gone right down, and obviously there's been big demand around there. So I remember looking at it and being quite nervous, and I just thought, let's look at this. Let's look at plan A, let's look at plan B, let's look at plan C. How can this go wrong? It was a bit nervous because it was £1 million purchase. It was quite early on in my career. And it was like, how do I do all of this? And it was through the creative structuring of finance that I managed to pull it all together without utilizing too much of my money or anybody else's money, in fact. So I think that was one of my greatest deals, really.
And do you think those kind of deals can still be done today?
You just have to do them in a different way. I've continued to do freehold to leasehold deals. I haven't done one in the last year or so, but I certainly did one not so long ago. And it just takes, these days it takes a little bit longer. You just do it in a slightly different way. Financing has changed. Everything changes in life, doesn't it? As things develop, there's more restrictions that come in, or things get freer. I mean, it just goes up and down, doesn't it? So you just do deal with what you've got in front of you, but the concept is still there in terms of, it is difficult for someone to sell a block. And if you can get, and if you can find, again, it's also finding a motivated seller, and looking at the circumstances of the seller, and that's what you need to do. So I had to work with, and it was kind of the first time that I was finding myself going through all of these title splitting stuff. No one was educating me on it. I kind of just fathomed it all out, talking to lawyers, talking to brokers, talking to all the different people I needed to talk to, so that I could pull together a plan and make it all happen, knowing how much money I had and everything. And I timed things in a certain way, and I was great at structuring deals. So in my early days, I got very, very good at structuring deals, because that allowed me to expand, and also I quite enjoy that. So I'm quite pleased with that deal because of the structuring, and I guess in a way the boldness.
Yes, absolutely. The courage that it took to put that together. And I think it's interesting because, you've been investing in property for, reasonable amount of time. Was it about 15 years or so?
Yeah.
So, you've seen the markets go up and go down, interest rates go up and go down, mortgage lending be very free and then be very restrained and then be very free again. And I think when you've been in property for a long time, you become much more inured to those market changes. You realize that actually property, if you stick with it for the long term, really pays its way. But we have to be prepared to navigate those seas of high waves, low waves, high waves, low waves. And I think for new investors, it can feel very uncertain and fear mongering. That there's lots of fear mongering that goes on about it. Oh, what's going to happen about this? Oh, what's going to happen about that? But of course, my bottom line, I'm sure this is similar to yours, Mike, is that people always need somewhere to live. There's always a demand for residential property. And at the moment, we don't see the population figures in the UK going anywhere other than up. So there's always an increased demand, and therefore we're always going to be in need as property investors and property developers. The trick is knowing how to, I think, utilize some of the options that are open and be creative, but also not lose too much to the tax man, which is always a threat to a property business, is the tax regime becoming tougher and tougher and tougher.
Yes, I mean, tax, that's the other thing I've noticed since I've started investing. And I always remember when I first started and talked to people who've been investing for a while, it was like, oh, it's so much tougher than it used to be. And I'm like going, but when you come into those circumstances. So if you're new into property, it's just the circumstances you're dealing with now. So I wouldn't worry about it too much. And I have heard people going, oh, well, the tax regime's getting a bit strict. I'm not quite sure I'll invest. And it's like, well, then what else are you going to do? And it still makes money. It's just not as much money as previously, or you need to be smarter with what you're doing. And there's, with every problem, there's always a solution, isn't there? There's always some form of solution. And at the end of the day, the other thing is if you have a big tax bill, it's because you've earned some money. So that's not a bad place to be in. You should be more worried if you don't have a tax bill, because it means you're not earning any money. Yes. So, bite the bullet a little bit of like, okay, you're going to have to pay some tax. It's just harder because for us, if you run a business or you're self-employed, you see the money going out in tax. When you're employed, you don't notice the money because you just feel the money hits the bank account. Notionally, you're paid more, but it just goes off to the tax man. You don't think you can do much about it, so you just accept it. You might get a bit annoyed about it, but that's all you kind of do, isn't it? You kind of do that. Whereas for us, it's very painful because quite often we're having to send money off to the HMRC and pay our tax bills. So we think about it a lot more and we have more flexibility. So, you're better off really being a property investor rather than PAYE, because you can't offset much on PAYE. Whereas in running a business, you've got legitimate costs you can offset, and you can structure things in the most tax efficient way. You know, through my life, obviously, when I first started buying in my own name, now it's more tax efficient for me to buy in a company. So when I add now, I buy in a company. So you just adapt and change things. So I wouldn't let that stop anyone who's thinking of getting into property. You just learn what the current method is, and that's why it's really important to get expert advice on,
Yes.
on the different areas of property.
Well, I think the other thing is that, you know, if we look back at interest rates, 10 years ago, the average buy-to-let interest rate was 6.5%. Now, the average buy-to-let interest rate is about 2.5%. So while you now really the best way to do this is through a limited company, unless you're doing something possibly like serviced accommodation where you have a different tax regime, but for residential property, you want to be doing it through a limited company. But actually, even within limited companies, you know, people say, oh, I'm having to pay 3.9% for my mortgage. You think, yeah, that's actually nothing compared to what it was 10 years ago. And even before that, I remember mortgage rates being much higher. And I remember a time when you couldn't even get an interest-only mortgage. It was all capital repayment. So that, you know, these things ebb and flow. And you know, I think long-term property just makes a very, very sound investment. What I'd like to ask you though, Mike, is we talked about a really good deal. That's a very impressive deal in London. What about a bad deal? Come on, you can share. We're all friends together here.
Ooh, bad deal. I guess probably the first one I talked about probably was not such a good deal. I don't regret it because it got me going in property, didn't put me off. And what did I do wrong, or what were the key learnings? The key learnings, as I said, it was a source deal. So did I trust the sourcer? I was a bit skeptical, but I didn't know enough, I don't think, to really understand everything about it. So I bought it. So I did some things right because I, you know, went to view the property. It all looked nice and done up nicely. I was also, you know, it was a student property. It was close to the university, tick box, you know, all these kind of things. Students are lazy. However, the area was not a very nice area. And they said, oh, we're buying up a lot of these properties and it's all going to come up in value. And I was thinking, okay, that will probably be okay. But the students didn't really want to live there. So it was always hard. So rentability was low. I'm very keen. I think we talked about this last time. I'm very keen on rentability at the moment. That seems to be my phrase, but rentability. And the rentability was pretty low. I also had a rubbish agent. It was attached to the sourcer and they were rubbish. They were basically overwhelmed. They didn't have processes and I didn't know. I didn't kind of really twig all of that. So initially it was fine because when I bought it, to safeguard myself, they guaranteed some rent. And then I was hoping for the next cycle, but they kind of missed the cycle. So that meant what was a 5-bed HMO. Eventually I had about 3 tenants in, and that's when the problem started. So I never really I didn't make much money out of it in terms of cash flow. I didn't really lose much money out of it because also after a while, when it started to get worse and worse, the interest rates went down. So that also helped. So it was not that great. And also because what had happened, they gave me a kind of a bit of a gifted deposit, which meant I didn't have to put much money in. But what I realized over time was HMOs in that area weren't the same as HMOs in another area because they were far more rentable. So they generally were worth a lot more than my HMO. And then if you can't fill it, no one else really wants it, does it? So the value is kind of slipping down. Mm-hmm. So it wasn't worth much. And I knew over time it would probably come back, but it did drop a lot in value at the time. But again, as long as you don't have to remortgage or do anything and you're paying your way with it, which I was, and also I, you know, got more experienced, then it's okay, isn't it? And I guess the learnings were, one, it wasn't in an area I really knew because it was up north. It was in Leeds, near Leeds University. They then built some big halls up there, so it was probably affected by that because being in the worst area, you know, when the demand's low there. It's like out of sight, but out of mind, out of it just, I learned then I need to have things a bit closer to me so I can keep control in that way. That's the way I manage. So a lot of learnings. I don't regret it because I got into property. I've got the confidence to get into property, and it went down in value. In actual fact, I then did a negotiation with the mortgage company, because the mortgage company I think that I had it with went bust, and they'd obviously then sold their loan to someone else. They obviously sold that loan book very cheaply, and therefore they just wanted me to redeem the mortgage. And it was like, well, I can't remortgage because sorry,
yes, you're in negative equity.
I won't be able to redeem the loan. And they went, oh, how much is that then? And we got in, and I just thought, well, do you know what? I could probably remortgage and keep it, but it's out of sight, it's off strategy. Let's just get rid of it. So I actually sold it, and they wrote off a large chunk of my mortgage.
Wow.
To get me to sell it. So really, I didn't really lose any money on it. My purchase price to sale price was a lot less. They wrote off the mortgage.
That's great. That's a good solution.
It was a good solution at the time. So
okay, that's great. So I'm interested in this phrase rentability, Mike. So you now have a portfolio now, mostly I presume in the southeast of the UK. You've got stuff in London, you've got stuff on the sort of south coast and southeast. Who manages your portfolio now?
My team. So I have a letting agency, Viva Living, and they manage my portfolio.
And do you have much involvement in that, or do they tend to get on with it? And
they tend to get on with it. I don't. I mean, I've set it up. I don't. I mean, the big test really was earlier on this year when I was quite ill in hospital. The whole thing ran without me for that length of time, and then obviously I was ill, still recovering after that, and wasn't getting that involved. So the actual amount of time on, if I'm not acquiring, and if I'm not renovating, and just managing and running the portfolio is a very small amount of my time. It is actually a very small amount of my time. It doesn't mean it doesn't sometimes cause me grief. That's slightly different, but it is a small amount of my time, really, physically of my time.
And what would you put that down to? Is it because you're brilliant at systems? Is it because you've got a great team? Is it because you know how to recruit the right people? Because a lot of people would say, oh, I wish I could run my portfolio myself, but I have to use an agent. But you've done it. So what's the secret to your success?
Yeah, it's a combination of people and systems, really. I think you need both. You need very good people and you need systems. Because if you have very good people who don't know what they're doing, then it doesn't really matter, does it? If there's no clarity into what their role is and what they should be doing, and no tracking of what they're doing. So, as I said, it doesn't take me long. That's because I track what's going on. And then I need to delve into something, I'll say what's going on. So if I can easily look at what my arrears are. I can easily look at what's empty or coming empty and talk about, well, what's the issue here? Or why is this not letting? Or what do we need to do here? And those are my conversations to do with lettings, really. Occasionally around some problem tenant that I might get drawn in on. But the team have quite a lot of experience now, which is good, because they've been with me for quite a long time. So, for me, it's a balance of systems and people, really.
And it sounds like one of the key things for you is measuring those key performance indicators. You've obviously got some ways of looking at those key figures, the key metrics in your business that give you either confidence or a reason to take action, so that you're not doing the day-to-day, but you're measuring and tracking what's going on.
Yes. Yeah, I guess that's my key role in the management side is just to keep an eye on what the metrics are doing and chatting, and then you're constantly looking at the metrics, and your team then understands that that's what they're being measured by, so they try and perform towards that, I guess. And if there's a problem, then they need to, that it can be identified and resolved quickly.
And I think, as you say, your experience this year of being poorly for quite a number of months was testament to the fact that it can work without you actually being in situ, which is quite a powerful test, really, isn't it?
Yeah. That's what I was telling myself when I was on.
when you're on your deathbed.
Yeah.
This is just a test to see
So
whether Viva can cope without me.
Just testing them. And the roasted, yeah. So there's all sorts of things you can do, but it's so not only is it the right people, it's the right people are different, so put them in the right box. So if you're doing the lettings and the viewings, you're going to be more outgoing, chatty, enjoy the more salesy type things. If you're doing all of the paperwork or the checking up on making sure we've got the gas certs, the EPCs, all the compliance to do with HMOs and payments and that's going to be far more processy, paperwork detail. It's going to be far more detailed. So make sure that you've got that balance, or and the right people doing the right things, because I often find people go, oh yeah, I'm wanting to bring someone in and they're going to do this, and this. And I'm saying those tasks are completely different skill sets. So you'd be very, very lucky to get one person that can do all of that. And if you do, they probably won't stay with you that long, because they'll be that good. They'll be going on to do something else, because your fledgling business probably can't afford to pay much, and etc. So I'm very into, I have a role. I know the type of character of person that you need, and I will recruit that person into that role.
So one of the things you mentioned earlier is that you're a creator, and I understand what you mean by that, is really in terms of the wealth dynamics profile. Yeah. And I know that you've been really interested, as I have, in the whole arena about personality and utilizing your innate entrepreneurial skill to maximize what you do, and not to try and do things that you are not naturally good at. So can you say something a bit more about that and how you've used that in your business, Mike?
Yeah. So, I mean, as a creator, you like to develop and grow and do new things. And it's about future forward looking, and you're great at solving problems, getting things going, but you're less good once you've got everything going to actually run it. So my skill is not in running a property portfolio. I did try for a while, and actually I did do it for far longer than I should have done, and that held back my growth, to be honest, because I was doing the things that I wasn't so good at, not enjoying it so much, not doing it so well, before I got people in to help me. But where were we going with this? So by understanding that, then when I get support, I know what I need in someone who's going to support me. So as a person with my characteristics, I need someone who's going to support me and support me well. I can be good at communicating at times. I can be absolutely really terrible at communicating sometimes. So my ideas, my drive, my innovative thinking needs to be funneled through someone who's going to help me then implement it. Otherwise, I could have all the ideas in the world and they never get implemented. And an idea that's not implemented isn't very powerful at all. So I need someone sort of helping me implement things to the side. So I'm a great believer, as you said, of wealth dynamics. And they talk about having a stool, and a creator needs certain people. They need a supporter. My PA is a supporter, and then you have an accumulator, and I've got an accumulator lord also in my team, and they're my kind of core cogs, and they all do their different roles exceptionally well, because they fitted in. So we all work in a good balance. So
I think in most teams, really, one creator is about all that most teams can cope with.
Yeah, and this is where I also find people tying up. They start going network meetings and they find another creator and they go, wow, we've all got the same visions and we've all got this. Oh, we've got the same mindset. This is brilliant. Let's go into business together. That doesn't work at all.
No. Because there's no complementary skills or approach, is there?
Yeah, there's no balance. And I'm quite a creator, so I'm quite far out in that spectrum. So I do need that other stuff. But then people are surprised, because one of the secondary natures of a creator is a mechanic, and you get a lot of ideas. So a creator will get a lot of its source ideas and solutions from data and from stats, and you heard me talk about KPIs and stuff like that. So a mechanic actually is quite into the technical bit and can do detail. A creator can do detail actually, and can pick up detail and actually can spot imperfections in detail, or I can anyway, imperfections in detail quite quickly if I put my mind to it. But you've got to be in that mode. So don't get me wrong, is to like, can I do, I can do detail and I remember things. I just do it in a different way, maybe to a lot of other people.
Well, I suspect that probably the way your mind works is more that how is this data actually going to help me? How's it going to serve me? How's it going to make me create something of value? So for me, one of the things that I like to look at, I like to keep an eye on, is some of the facts and figures around the property market, the property industry. So I'm looking at data around employment and unemployment. I'm looking at data around government borrowing. I'm looking at data around other statistics, which I think help me to become a better investor, because it helps me to understand what's going on in the economy and what's going on with the housing market. So there is a purpose behind that data-driven interest. It's not for its own sake. It's not to crunch the numbers. It's not to become a statistician, which would be somebody who's maybe more of a lord or an accumulator, but it's really to serve, to help me to create more. So I think there's an element in which some of that is really about helping you to be to feed into your own desire to do deals, to create deals, to understand what's happening in the market and so on.
Yes, and also to unpick things. I think I'm very, I am creative, but I'm also very solution focused. And in order to provide solutions to problems, you need to delve into them quite a bit. So you have to unpick things, and you do have to get into the detail at sometimes. And I think that then solves things. on the whole social housing, it's all done on the detail, and so I got into the detail. And unpicked all of what that meant, and then I had to take what I learned and implement it. No one was telling me how to implement this stuff, so a lot of people who then come on my courses and stuff, obviously I'm showing them how to implement it. I had no one to show me how to implement a lot of that stuff. I had to go about and just do it. But that's the challenge. That's the excitement for me as a creator. You're doing something and inventing something new and learning as you go along, but you need the detail. You need to be living and breathing it and delving deep. That's the other thing. Delve deep and narrow into whatever you're doing to master it. And if something goes wrong, you learn, you tick and you improve it and go again and see how that runs, and then go again and slowly improve and keep improving it. I guess that's the difficulty as a creator, because we want to change things too much. Whereas the rest of the team are like, just leave it be, please. Yes. Please leave it be. So we're working on a different pace to other people, because we're already thinking of the next thing before we probably implemented the last thing, in terms of it, even on a process change, we'll be thinking of how to improve. We've just decided, right, we need to change this in the process. So once we've decided that, we think that will automatically get implemented, and we're thinking of how to improve it again the next time. And of course, the team members are still trying to catch up with the fact that you've changed it, and wondering what you're doing. So I have to slow down in some areas. I have to speed up in other areas. I don't know. I'm not quite sure where we're going with this, but
well, it's interesting because it's all about people, isn't it? And one of the other things that you've done since you've sort of systemized and got a team is to develop training and mentoring programs for other people who want to invest in property. I think I first met you at a PIN meeting when you were talking about your social housing strategy. 2x2, is that what you?
Yeah,
2x2 strategy.
2x2, yeah.
Do you still do that, by the way?
I still do that. Yeah, I still train it and I still do it. I still have tenants that I've had for years. I mean, some of those tenants just remain with you for a very, very long time.
Yes.
And I look at some of the deals. It's funny. So probably some of the properties that I talked about, and I look at them now and I'm going, I've probably got the same tenants as when I presented to you. That then makes it, and that's what I mean, again, in terms of rentability. If people aren't moving out, it's obviously extremely rentable, or they're kind of like they're there and they're happy, or which is fantastic. So absolutely. I still do it. I've got a balanced portfolio. I always remain balanced as we see through the time. So that's been proven good in the in the terms of the pandemic. The government still continues to pay, so they continue to pay. and they're not likely to, they don't have a job to lose. So that's good. Whereas obviously if you've got some professional tenants, they might be losing jobs in these times and having difficulties and etc. And again, it's quite an intricate little system, but can be done if you know and understand it.
But property is very much a people game, isn't it? And I think that, while the data and the maths and the figures and the stats are all very important, and I think you've got to know your numbers on a deal, you've got to understand how to crunch the numbers, you've got to understand the cost of a refurb, for example, to be able to really calculate whether you're going to add value and whether you're going to pull money out of a deal. That mathematical ability is something which I think you develop much more of as you start to do property, because you have to have that skill. But I think ultimately property is actually about people, because as you say, it's about finding the right vendors, the people who are motivated to sell. It's about finding the right tenants. While you might not be doing it, you might have a team, but then you've got to find the right team. And what I've always felt is that if you miss the people element in property, you're probably not achieving what you could be achieving, because people give you the leverage. There must have been times though when you've also been maybe frustrated by working alongside people and thought, I wish you could do it better or quicker or something.
Yeah, so people are brilliant, people are terrible. So and that's probably been my biggest mistake and biggest learning to date is that people management side. You talk about what my worst deal in comparison probably doesn't compare into some of the people issues that I've hated having to deal with. So property doesn't talk back, property doesn't have feelings, so and the will of its own. So I know that I leave it there and it's going to be there when I come back in a year's time. I still know my property is going to be there, whereas people just do their own thing, don't they?
But you do like mentoring and training people, don't you? You've got quite a crowd of people that you help. So that they must see something in you, Mike, which they think, yeah, actually, we want to work with you. We want to learn from you.
Yeah, but I enjoy. I think there's a very different thing about having an employee and having working with someone who's mentoring. That is a totally different. In a way, a different relationship, isn't it? Of course, when you're employing someone, you help and coach and do all of those things. But working with a mentee or training people, it is a different thing to having them carry out tasks, and you're sort of going, why are you doing that?
Yes,
and dealing with a whole load of rubbish that could come with it. So. And I guess being on top of it all and confronting it and managing it and doing all of that, it's just taken me a while to learn some of those skills, I think. Probably.
Interesting. So let's just look forward then finally to the next kind of 12, 14 months. What do you think 2021 has in store for us in the property industry, but for you personally as well? What plans, what ideas, what goals have you got for next year?
Well, 2021, let's segment it out. What's going to happen in the property market? I think there's going to be some good opportunities in the property market next year, in 2021. Why? Because I think there's going to be less demand for properties next year. A lot of people have brought their purchasing plan forward because of the stamp duty holiday that's currently here. So there was a pent-up demand, and then that's also swept people to carry out a purchase now, as opposed to maybe they were thinking next year, or maybe they were thinking of waiting. So they just getting on with it. So there's going to be, I think, although there's probably also people have put their houses on the market, but there's always going to be reasons people need to sell. Death, divorce, debt always comes to mind. That's all going to continue, isn't it, next year? So therefore, there's going to be some motivated sellers, and I should imagine landlords will come into that as well. That therefore, I think there's going to be some good deals next year. So I think the volume will just drop. Whether the market will drop or not sure. But what will happen is I do believe that there will be what you want, which is hopefully the market won't drop too much, but there will be deals that you can have that have dropped. And that is almost the perfect marketplace for an investor to get involved in. So with that in mind, I've spent a lot of this year structuring myself to take advantage next year. So I've just launched a property investment fund, and we're out raising money currently for that property investment fund to deploy over the next 2 years, where we will be buying large blocks of flats. And it's also where I've got this whole rentability, because I've been doing a lot of analysis to work out what we should be buying, where should we be buying it, what should we be doing, what is our strategy behind all of this. And hence why I'm now very much in this, if I look back, the rentability is key and the good areas are key, because not only do you get that key rentability, quite often you get the capital growth with it as well. And to exit at the other end is going to be far, far easier as well. So it's a play to hold for 10 years. Essentially, it's a 10-year life spiral. We've been buying for 2.5 years, keeping and then selling out for 2 to 3 years. So that's the play, and we're raising. And so over the next few years, I hope to have a lot of properties within the fund and under management. We've got some big ambitions, and part of that is also branded living. So I want to bring in, you asked me what I used to do. I used to do branding and strategy. So I feel there's a place for a brand within the marketplace. So obviously we have estate agent brands, but we don't have home brands that much. There's like Fizzy Living, there's kind of things. So I'm thinking we need to create environments that are attractive for our tenants to live in. So we're going to create, we talk a lot about co-living, whereas I'm not sure, especially with the pandemic, whether co-living is really what we need. What I feel we need is community living, is creating a community. So still have flats and everything like that. So we'll be buying blocks of flats, but creating a community in those blocks. So we'll be buying the whole blocks, creating a community within that and within buildings, and branding it up, and also providing extra services and spaces and things within those buildings to really up the kind of delivery of living, if you see what I mean. And also with everyone suffering, a lot through mental health is coming to raise. So that's part of developing that community to really help all of that side. And there's going to be a give back side to all of that as well. So that's quite exciting, because we're talking quite a lot of money. We're talking with sort of really scaling up. We're looking to raise 200 million. And we'll gear that as well. So we'll probably have, around half a billion of property, and then we'll go again and again. So over the next few years, we plan to take quite a lot of properties, but you need that scale to get the branding, to get all of that management feel right. So that's quite exciting. So as I said, I think we're coming in at a good timing. We've just got to continue with the raising of the financing, the raising of the money. Yeah. So that's my big property play for the next few years. Great. And in terms of, and I will continue with the training, mentoring and things, because I just really enjoy it. And doing more of these types of things. Obviously, I'm launching my own podcast, and I just enjoy, like you, chatting to people on these kind of things. So I enjoy taking part, and I enjoy hosting them, and we'll continue to do those kind of things.
And when does your podcast launch, Mike?
So my podcast is launching. What is the date? It's very, very soon.
We can give it a bit of a plug on the show today.
Yeah, it is actually on the 26th of November.
Woohoo!
So
excellent.
That is going to be the first. We're releasing a few episodes together, and that's going to be the launch, the Property Business Accelerator podcast.
Property Business Accelerator podcast.
So we're talking about property and business. I guess a little bit about you, but there's going to be some business content as well as property content. Like yourself, I'm talking to all these different people in the industry, but I'll also be talking to business people and focusing on business, because I believe property is a business and you need to treat it as such if you want to do it at scale. So once you get over a handful of properties, it's no longer like a hobby, a side investment. It needs to be treated like a business. So those are the kind of people that I like working with. I can help people get going if they want to, but really now where I am, I really like helping people who know quite a bit, but I can really accelerate their journey.
Yes, absolutely. And help them to scale and presumably then systemize and outsource so that they can then benefit from the income, but not have to manage the day-to-day, just as you have done.
I'm often helping. I guess I'm often, a lot of a typical person I might be helping is someone who wants to get out of their job into this full time, or has indeed just stepped out into full time and like going, what help, or
Yes.
I need to do this, or I need to continue to grow. Otherwise, there's going to be some issues somewhere. Motivated people, but know that they'll get a lot of value and they know that it's worth it. And I also know that they're going to do quite a lot as well. So that's quite good. All circumstances have changed and it gives them an opportunity to focus on property for a while. It's probably my typical customer, or someone who might be running their own business and then can tack this on quite easily. So
fantastic.
Yeah.
Great. Well, we look forward to that. I know that's going to be a great podcast. Well, you've got some very good guests. Excellent. Well, listen, Mike, thank you ever so much indeed for your time today. It's been very interesting getting to know you a bit more about some of your background, your history, and I'm glad that you are now fighting fit and back to full health. I presume you are. You look very well. You look very well and healthy. How are you feeling now?
No, I'm still
suffering.
Yeah. My lungs are still not. It's very. I couldn't. I mean, you're a keen runner. I'm struggling to sort of do any of that. So it still is. It's a slow burn. It's not helped by the fact gyms have. For a long time I probably wasn't in a position to really do it. And just as I was getting back into it, gyms have all now shut down again. And I also went over on my ankle and twisted my ankle, so that was a good start. So I hobbled for a while, but my lungs now, I still cough quite a lot, and certainly still get short of breath. Even I'm doing a lot of walking, and at the end of that, I will still be quite out of breath. So it's going to be a long slog, but essentially I'm okay. I can operate day to day, but I want to get back to that. Health goes into performance and wealth and how well you're feeling. So
it does.
So definitely need to focus on that a little bit.
Great. Well, look, if you can't join me running the London Marathon next year, you can sponsor me instead.
Yeah. Okay. That's a deal. I have run it once, and so once was enough.
Yeah, I know. I must admit, I ran it once in 2019, and said never again. And then I entered again in the ballot, and I'm hoping I'll get in, but we'll wait and see. I'll let you know.
Mine was a very long time ago. It was 20 years ago.
Well, it's still good to have the medal. You can still say you did it.
I've still got a medal.
Exactly.
It was the year 2000, so it was a good year.
Fantastic, absolutely, and it just proves that you're a marathon player, whether you're a runner or you're a property investor. You're a marathon man.
Marathon man. Yeah, you need persistence when you're in this game.
You do. You absolutely do. Absolutely. Yeah, very, very similar mindset to running. It really helps me with business as well, because it gives you that persistence mindset.
Yeah,
great.
It probably clears the mind a little bit, I think, as well.
Absolutely. It's very, very good. Very good. Brilliant. Well, listen, Mike, thank you very, very much indeed. It's been really interesting listening to you and hearing from you. And I know that there'll be lots of people who'll be listening who'll be inspired by your journey, inspired by your story. And I'll put your contact details underneath the post as well, so that they can contact you if they want to, maybe to learn more about the fund or learn more about your mentoring and training business as well.
Yeah, brilliant.
Thanks very much indeed. Good to have you on.
Thank you.
Bye for now.
Bye.